This is Financial Standard, the definitive source of news, thought leadership and analysis for Australian wealth management professionals. Financial Standard. Take the lead.
I'm Cassandra Baldini with Financial Standard. On Monday, an 11th hour tentative deal was struck by US lawmakers to raise the debt ceiling and avoid a national default disaster. Of course, there are no guarantees the agreement made between President Joe Biden and Speaker Kevin McCarthy will get the support needed from the Republicans and Democrats to pass. Here with me today to discuss this further is AMP Capital's chief economist, Shane Oliver. Shane, thank you so much for joining me.
My pleasure, Cassandra.
So can you give us a little bit of an overview on what was in the 99-page bill text?
Well, it's a massive bill, as these things often are, but I guess the key elements are an agreement to increase or rather suspend the debt ceiling out to January 2025. So it averts the so-called fear of default that had been around for a while, assuming it's passed. In return for doing that, there will be caps on government spending, particularly for what they call non-defence discretionary spending. And basically that sort of spending will be capped at 2022 levels. So in other words, given inflation, there'll actually be a real decline in US government spending. And that's for at least for the next financial year and possibly the financial year after that, although there's a slight upwards drift that could occur there. I guess there were some other key elements in there. For example, in America, they have food stamps, which is a form of welfare program. The agreement will increase work requirements to attain those food stamps. There's also some measures in there which will speed up the permitting of so-called energy projects, which both sides of politics in the US were, of course, supporting, but, of course, the Democrats on the clean energy projects and the Republicans on some carbon projects. And there's also a measure in there which potentially speeds up funding of government. So there's always two issues in the US. One, the debt ceiling, and the other one is funding the government or agreeing a budget. And sometimes they can't agree a budget, and that leads to a shutdown in the US government. But there's some measures in this bill which help speed that process up and should avoid future shutdowns. It's not impossible, but it's quite possible these measures will accelerate the process and avoid shutdowns going forward.
And raising the debt ceiling was a necessity, but what implications are there to pushing it back until 2025?
Well, some would say it's just pushing the can down the road, that the debt ceiling will be forgotten about for a few years and then will come back in January 2025. I guess one of the key implications is in the short term it heads off any risk of default, assuming that the bill is passed into law by the due date, which I think is around June the 5th. There could be a bit of flexibility around that, but it needs to be passed soon. If it is passed into law, it heads off the risk that the US government will have to slash government spending to eliminate its budget deficit. So that's the good news here, and that's why markets initially welcomed the news. But of course, the issue will then come back again in January 2025, which of course is the other side of the next presidential election, which is in November of next year. But of course, the new president will then have to deal with the debt ceiling. Of course, if Republicans win, then it'll be less of an issue because they tend to be less focused on fiscal conservatism, whereas if President Biden wins or a Democrat wins, then of course we may go through the same issues all over again.
There are predictions a US recession could hit in the second half of 2023. Do you think that's likely, and why hasn't pushing back the debt ceiling helped the nation swerve such an event?
Well, I think that risk of recession was there anyway. It's been a focus for some time. Many economists have been forecasting a recession in the US sometime in the next little while. In fact, those forecasts started to appear early last year. So that recession risk is there and it's high, and it's mainly due to the tightening in monetary policy that the US has seen. And some people get a bit technical here and they cite a thing called the yield curve, which is the difference between long-term bond yields and short-term interest rates. And it's gone inverted with short rates above long rates, and often that's a sign of potential recession down the track. So that risk was already there. The debt ceiling and the threat of default just increased the risk of recession. But removing the debt ceiling just removes an additional reason why we might have a recession, but it doesn't head off the risk of recession entirely. I think if we didn't increase the debt ceiling and the US government defaulted and slashed government spending, that would be almost certain they would slide into recession because they'd have to cut spending by about 7% of GDP. But the risk of recession is still there, and it's still high, but it's mainly because of the tightening monetary policy we've seen.
What about the impacts for Australia? Will the debt ceiling raise have any impact on us?
To be honest with you, I don't think will have a big impact, assuming it is passed through Congress. We saw a bit of a celebration on Monday. Our share market went up in response to news that a deal had been reached. If it's passed by Congress, we might see a further modest rise, but I think thereafter the share market will go back to focusing on other things. The issues I think that are critical for Australia are obviously whether we have that US or global recession, and how much further the Reserve Bank raises interest rates, and a lot there depends on inflationary pressures. But you'd also have to say the risk of recession in Australia is quite high, and the more the Reserve Bank keeps raising interest rates, the bigger that risk becomes.
What if the US does plunge into recession? Will we feel the ripple effects here, and what kind of impact could be expected locally?
Well, unfortunately, we will feel the impacts of a US recession. The US is still the world's biggest economy. We saw in the past that when the US has gone into recession, it does affect Australia. It doesn't necessarily mean we will automatically go into recession. We saw in the tech wreck in the early 2000s and the GFC that the US had a recession. We avoided it. But of course, in the early 90s, we weren't so lucky. And of course, in the pandemic, we all went into recession because we shut down our economy. So it was a bit different. But we will see the effects. And of course, we did see sharp slowdowns in our growth rates through the tech wreck and in the early through the GFC. So we will be affected. And it occurs because a weaker US economy means weaker global growth. That means less demand for our exports, particularly commodities. And there's also a confidence effect that we get a lot of news from the US and people feel more negative when the US is in recession, and that affects spending in Australia. So the risk is that, yes, if the US goes into recession, it would be a big dampener for us and increase the risk of recession here. Now, mind you, a recession in the US and Australia is not our base case, but I would have to say it is a high risk, and the more central banks keep jumping on the brake with interest rate hikes, the more that risk goes up.
Wow, that's interesting because it has been a popular opinion that Australia will swerve a recession. What are your thoughts on what the RBA will do next in that case? And do you think that we will be that lucky?
Well, I think a lot does come down to the RBA, and most forecasters have growth slowing down. The budget released early in May showed a slowdown in growth in the next financial year to 1.5%. The Reserve Bank's own forecasts have growth slowing down to 1.25%, and we see growth slowing down a little bit more than that, but below 1%, but avoiding a recession. But I think it is critically important that interest rate hikes soon come to an end. I'm hopeful that maybe we have seen the end of rate hikes, but of course the Reserve Bank continues to surprise on the upside. And obviously a big factor right now is what wages do, and a big influencing factor, and that is the minimum wage case, which I think a decision is coming up on soon. There is a worry that if a bigger increase in the minimum wage and therefore award wages is granted than what we saw last year, which averaged around 5%, if we get a bigger increase, say 6% or even 7%, as the ACTU has been asking for, then that could trigger more hikes from the RBA, because the RBA would then worry, well, if the minimum wage has gone up by 6 or 7% and award wages have gone up by something similar, that will have an influencing effect on other wages in the economy, all at a time when some states have removed their public sector wage growth caps, New South Wales and Victoria, and we've also seen the 15% rise in aged care wages. So all of those things could build upwards pressure on wages growth. I know economists sound like spoil sports here, but the concern is that if wages growth gets too strong, just matching inflation, then it will lock in high inflation and make it harder to get back down again. And so the Reserve Bank would respond to that with more interest rate hikes. So hopefully we don't get an outsized increase in the minimum wage. And I'm not trying to deny lower income workers a bit of help here, and I think they probably deserve it, but a better way to do that would be the budget, believe it or not, with some sort of accord type deal. But I do worry that if wages sort of take off, then it will make life a lot tougher for the Reserve Bank, and they'll end up raising rates more. And that in turn increases the risk of recession in Australia, because you've got a third of households that are already struggling. many of whom are already struggling in response to higher interest rates.
Well, the RBA Governor, Philip Lowe, is being questioned this morning in the Senate estimates hearing. So it'll be quite interesting to see what comes out of that. Do you have any predictions?
Look, I think he will repeat the message that he's repeated for some months now, and that is that they've done a lot in terms of tightening monetary policy. There are early signs that inflation's peaked and that growth is slowing. But they are still concerned that inflation is too high and there are risks around things like wages, which means they may have to raise interest rates again. So I think that's what he will probably say. We think they've done enough, but I can understand where they're coming from in terms of their desire to head off a situation where inflation gets locked in at high levels, as we saw in the 1970s and early 80s. If you go back to that period, workers got wage rises matching inflation and so on, but all it did was we were just chasing our tail, and we ended up with very high unemployment at the end of it, double-digit unemployment, and I think it is critically important to avoid that.
Well, it seems like there's still a lot of uncertainty, and we're going to have to wait and see.
That's right. I think for investors, for example, it's going to remain a fairly uncertain period. I think there is light at the end of the tunnel, though, and that is that if you look at inflation pressures globally, they are easing. If you look at commodities, go back 12 months or more ago after the Ukraine invasion by Russia, commodity prices were surging, oil, copper and so on. They've all come back down, so pressure has come off there. We've seen supply chains return to normal. Delivery times have improved dramatically. Business surveys around the world have shown, and in Australia have shown a declining trend in output prices and input prices. So all of those things are consistent with the pressures coming off. But obviously, right now, central banks worry that inflation is still too high. But the light at the end of the tunnel is that if inflation continues to slow as growth cools down, then hopefully by later this year, or if not, then early next year, central banks like the RBA and the Fed will be in a position to start cutting interest rates. So that should be helpful for investment markets, but obviously we could go through a bit of a rough drop before we get to that point.
Well, in that case, we'll have to we'll leave it on a positive note. Shane, thank you so much for joining me today.
Thanks, Cassandra. All the best.
Thanks for listening to this Financial Standard podcast. For more information, visit financialstandard.com.au. Please keep in mind that the information discussed in this podcast is general in nature and does not consider personal circumstances. Reliance should not be placed on any content without further independent financial research and advice.